in an increasingly liquid CCO, bilateral CCO market for forwards. So that's future delivery contracts for offsets, compliance offsets. Again, the more liquid month is December of 2013, although we're structuring transactions for buyers to be able to take delivery of the instruments right when they need them. So the first surrender date for California is in November of 2014. That is the annual compliance obligation, 30% of 2013 emissions must be surrendered. Compliance instruments must be surrendered. So we're structuring contracts around that particular time frame. CCIs are another less actively traded, but nonetheless it's an active product that's available to the marketplace. That's a bundled product where the seller is delivering 92% allowances and 8% golden offsets, or seller guaranteed offsets as they're also called. Those are traded bilaterally, they're not on an exchange. The only exchange cleared product is the allowance. So futures are traded on the Intercontinental Exchange, and that's where most of the volume that's clearing is going through. In terms of active participants, you have energy trading companies, power generation companies that are delivering power in the wholesale market, are active buying allowances in the secondary market. You also have a variety of banks that are providing liquidity in the market, some hedge funds, and then other compliance entities and project developers like offset projects. In terms of pricing, I broke this off. I broke this down into a couple of different products. The pricing has been, for allowances, has been range bound between 14 and 15 bucks for a few months now. So you can see that there's generally about a $3 cost savings to go the route of buying a golden offset. And again, golden offset is where the seller is a good credit counterparty, typically investment grade, will be making a commitment contractually to deliver a guaranteed compliance offset, meaning it's guaranteed from a delivery perspective, so there's liquidated damages provided in a contract. So in the event the seller defaults and fails to deliver, there will be a financial settlement to make the buyer whole effectively. So it's firm delivery. In addition to that, it's also guaranteed from an invalidation risk perspective. So if it gets surrendered in ARV, invalidates the instrument, ultimately that will be replaced by the seller. And then, of course, there's a CCO 3-year invalidation risk and an 8-year. And you can see the price difference. I think as mentioned earlier, taking some incremental risk in the offsets market could lead to greater cost savings. This is sort of the contract specs for futures. As I mentioned, it's the more actively traded instrument in the California carbon market. Vintage 13, December 2013 delivery is the most liquid contract by far. And I don't want to get too much into the specifics of this contract, but generally it moves at a 1 cent minimum price tick, meaning that the contract fluctuates, can fluctuate at a penny. It's a bundle, so one contract, if somebody's going to enter a long position to take delivery of one contract, that is 1,000 allowances that they would be entering into a contract for at a specific price. Futures, spreads, calls and puts. Calls give you the right to purchase at a pre-agreed price. Puts give the owner of the put the right to sell at a pre-agreed price, or strike price. So options have been very active actually recently. As I mentioned, the price on carbon has been relatively stable for the first half of this year. It's been largely range bound between 14 and 15. Before the songs announcement came out, there was a fair amount of call buying, so folks were entering into call positions for the right to purchase allowances at a price of strikes between $15 and $20 is pretty much where it was. The reason for folks wanting to do that is because after the songs announcement came out, the market was expecting a rally. So owning the right to purchase at a pre-agreed price gives somebody protection in the event that carbon goes screaming up. More recently, since the songs announcement, there's been a a fair amount of put buying, so that has been folks purchasing the right to sell at prices between $11.50 and I would say $15. And so, you know, as a broker and as an active market participant, we look for clues in what the market is doing and what the market is telling us. Heavy put buying, you know, could be an indication of folks, you know, buying protection in the event, you know, that they may be expecting a decline in price in the near term. Or it could be folks protecting, you know, they have a big position of allowances and they want to buy some downside protection to mitigate any sort of loss. This kind of gives you a sense of the escalating open interest in futures and options for carbon. You can see from the beginning of the year, there's been a lot more buying and a lot more open interest in vintage 13 allowances. Excuse me. And this kind of gives you a historical price graph. Last summer, you could see the price rallied up to about $20. That was due to announcements about songs being offline, and then it sold off pretty aggressively and then stabilized between $14 and $15. And that's sort of where we've been for this year. So closing comments overall, every sector that's capped in this market has been active in one way or another. Volumes and liquidity are certainly healthy. I would say that it's you know, it's certainly better than last year. I think we have a ways to go between, you know, before we could call it a liquid market, but you know, it's relatively stable and in good healthy demand. Obviously, it's been an escalating price each successive auction. Also, we've seen future vintage allowances become a bit more active recently, which, as Steve Cliff mentioned earlier, is an indication of growing confidence, I think, in the program overall. So with that, I think we'll get to the panel and hopefully answer some questions. Thank you.